It's my pleasure to kick off this webinar on this very important new academic study. The study argues that the SPIVA scorecard substantially and consistently understates the performance of active management due to certain empirical choices in the methodology. It concludes that, broadly speaking, the scorecard is too negative on the value of active managers, and that active managers perform much better than the scorecard has reported. The study was conducted by Professors Martin Kramers, John Fulkerson, and Tim Riley. They have been studying these issues about active management for many years, and we're honored to have Professor Riley and Professor Fulkerson here to discuss the paper. I'll be brief in introducing them, but I do commend you to their impressive bios on our website. Professor Fulkerson is professor and chairperson of the Department of Economics and Finance at the University of Dayton. He has a bachelor's degree in mathematics, an MBA, a master's in economics, and a PhD in finance. Professor Riley is an associate professor in the Department of Finance at the University of Arkansas. He also has a PhD and has worked on mutual fund liquidity regulation as a financial economist at the SEC. Unique perspective. Dr. Riley is an active CFA charter holder. Before we get into this study, I want to note that the study was supported by the Investment Advisor Association and our Active Managers Council. The Council's mission is to balance the narrative in the market about active and passive managers to correct an imbalance that we've seen over the years in reporting on active and passive management. We engage with policymakers about the importance of remaining strategy neutral, and we provide research on active and passive market management, The Council has long maintained that the active-passive scorecards are overly negative, and we were pleased to support this research. With that, I'll turn it over to Professors Riley and Fulkerson. As Mike said, please send along your questions, and we will respond to them after the initial presentation.
Thank you, Karen. So thank you all for joining us today. I'm Tim Riley from the University of Arkansas. I'll be co-presenting with John Fulkerson at the University of Dayton. And this presentation is built around two papers that we co-authored together along with Martin Kramers at the University of Notre Dame. And I think the best place to start is at the beginning. If we go back to the 1970s, index funds were just beginning to launch, and Edward Johnson, then chairman of Fidelity Investments, remarked, "I can't believe that the great mass investors are going to be satisfied with just receiving average returns. The name of the game is to be the best." And if we then jump forward to 2010, it appears like Edward Johnson was correct, that the great mass of investors as of that time had not shown a strong preference for passive investing. At that time, just 19% of assets were within indexed products. However, if we jump forward to 2025, it appears Edward Johnson has been proven incorrect, that the great mass of investors, as of last year, had shown that preference, with 52% of assets now being passively managed. We can see this same trend if we look at flows to active and index products. In this case, for domestic equity products. What we see in this figure is that in terms of flows, there's almost a one-to-one correspondence between money flowing out of active funds and into index equivalents. In this case, over the last 10 years, we've seen about $3 trillion flow out of actively managed domestic equity mutual funds, at the same time that about $3 trillion has flowed into index equivalents. We can also see this in decisions made by the US government. The Trump accounts were recently announced and are set to debut in July. These are tax-advantaged accounts that parents can set up for their children. And in July, when these accounts launch, I certainly intend to set one up for my son RJ, who just finished up kindergarten yesterday. But when I dive into the details of these accounts, what I see is that they specifically only allow index funds. Put another way, the pro-indexing argument has grown so strong that by federal mandate, I won't even be allowed to consider choosing active management within that account.
So we think that this mandate and these other trends that we notice are consistent with what we call the conventional wisdom on active management. This conventional wisdom states that active management does not create value for investors. It could be stated in a few different ways. I have three ways that has been articulated by different people. So the first one being that the average fund underperforms after fees. So if you look at the average actively managed mutual fund and you calculate an alpha, you find that on average that alpha will be negative. The second way that we see this appearing is around persistence, and that is that the performance of the best funds does not persist through time. So if we were to rank funds by higher performance and looked at the subsequent returns of the best funds, you would not find that they had any particular outperformance in the future. And so another way to put this is that the performance of the best funds would be attributable to luck rather than to skill. And then the third one is a little bit the other side of that, saying, well, we're going to recognize that some fund managers are skilled, but these skills do not exceed the costs that it takes to invest in these particular funds. So all three of these are variations on the idea that active management doesn't create value for investors. So what Tim and Martin and I did was we decided to review the academic literature to see to what degree does this support this conventional wisdom. And in 2019, we published this article in the Financial Analyst Journal, challenging the conventional wisdom on active management. And we draw the conclusion in that setting that the conventional wisdom is too negative on the value of active management. If you were to look at the 3 points that we listed, there is some evidence actually that there is value added by active managers. And I'm actually going to walk through some of those right now to kind of set the stage for what we understand from the academic point of view about the value of active management. So taking the first point that the average fund underperforms, an example from the literature that would support this is the Sharp 1991 article. In this setting, argues that active management must be a zero-sum game, gross of fees, meaning that if you have someone who outperforms the market, there must be someone who underperforms the market because on average, everybody earns the market gross of fees. But then it becomes a negative sum game as soon as you charge any fees because the cost must, of course, on average, bring everybody's returns down. So, mechanically, the average fund has to underperform relative to a market. There is more recent literature that suggests that that's not necessarily the case. And we cite, in this case, the Burke and Van Binsbergen article. In this case, they're looking at performance relative to a tradable benchmark, a distinction we think is important because it's to earn a market return, you're going to incur some costs, and so those costs should be reflected in how you evaluate the performance of an active fund. So kind of considering that the passive fund would be the opportunity cost, right? Once you do evaluate funds against a tradable benchmark, that evidence of underperformance it somewhat disappears. So to kind of illustrate this, here's a chart taken from that study or summarized from that study that looks at the performance relative to the Vanguard benchmark, which is the return on a Vanguard fund following the benchmark that a fund is declaring as their benchmark. And look at the performance for those funds, and on an equal weighted basis, we actually see it's positive once you compare them to an index fund that has the full cost of trading a passive strategy on it. Whereas if you employ the Carhart model, the more typical academic risk factor model, which includes these non-tradable factors, and instead you would get a negative alpha. So two different comparisons, but I think Burke and Van Binsbergen are arguing that you need to incorporate the true cost of investing in the passive option. If you do it on an evaluate basis, you can see the Carhart model is even more negative, but when you compare it to the benchmark, it's approximately zero or about minus 10 basis points per year. Considering the second point about performance persistence and our manager's lucky, the other way to put it, the key study that people will look at is the Carhart 1997 study. The study is seminal on like 3 different topics and is highly cited, one of the most cited studies in the literature. For the purposes of today's discussion, thinking about the value of active management, Carhart does a study which effectively, sorts mutual funds by prior performance and then looks at subsequent performance employing his risk factor model as a measure of performance and doesn't find that the best performing funds persist through time. It concludes that the explanations of strategy and investment costs account for any predictability you see in mutual fund returns. Now that was state of the art in 1997, and it is cited because it is impactful. But since then, statistics have changed in how we think about this area. This Kosowski et al. Paper considers some of the statistical issues associated with making that comparison by sorting funds, and they claim that their findings overturn some of these important results, specifically as relates to persistence. To get a sense of what that looks like, if you look at the past performance, if you sort in past performance and measure the alpha in the subsequent year, for the top 5%, and again, this is taken from the Kosowski study, look at the top 5%, the alpha was 1.4%, and the top 10%, the alpha is 1% over the subsequent year. But then, as academics, we need to determine, is this a statistically significant measure? And the normal is does it fall below a 5% p-value? When you look at the past performance using the Carhart measures, the performance is the same, but the statistical measure fails to reject that the hypothesis, so we would not say is statistically significant. Once we account for some of these statistical issues, the biases in this approach, Kosowski does find instead that it is statistically significant, so we can't see that there's performance persistence. Turning to our third point, thinking about skill and excessive costs. The Fama and French study thinks about comparing gross returns and net returns, and they do some simulation work, and they conclude that the few funds are able to produce a benchmark adjusted return that recovers the cost taken to get to that. So the assumption there is that while there may be some skill on a gross basis, on a net basis, that disappears. About the same time, there begins to see some studies come out that show that actually there is some measures that you can look at that seem to predict performance other than past performance. And there's been several from that time, but one of them, a co-author on this study, Martin Kramers and his co-author, proposed active share as a measure that is predictive of performance. Active share, if you're not familiar with it, is a measure of to what degree a portfolio's holdings deviate from the benchmark holdings, and they find that funds that are high on active share or who are very different from their benchmark outperform both before and after expenses in the following year. If you look at they divide things into quintiles, so that if you look at top 20%, they find a subsequent return of over 1%. Even if you look at the top 40%, you still see some average outperformance once you conditional on the active share. So the leap to make from here is that there are some measures that do seem to suggest some skill in active managers. Skill is a difficult thing to measure, so we can only do it indirectly, and perhaps active share is a way to do that. So taken as a whole, you may say, well, you look at all these studies, and you might agree that the conventional wisdom would be too negative on that. When we turn to look at the media, however, we see this example, New York Times measure for measure index funds rule. And Wall Street Journal refers to this as a rout and refers to that the stock pickers are beat by indexes 92% of the time. We get uncomfortable with that because we feel like if we view the literature like it's more nuanced, and these would be far too negative relative to what we observe in academic literature. One particular example to highlight, and this is just a good example that's recent, we've seen others along the same lines. So from March by Burt Maciel at Princeton, talking about if you're worried about what the market's going to do, you should invest in an index fund. And the highlighted section here is you should do that because if you look at performance over the next 10 or 20 years, 90% of actively managed funds will fail to beat the market. So 90% is a big, particularly when you compare that against the academic literature that we were reviewing. And where does the 90% come from? Well, it comes from the Standard & Poor's report, the indices versus active, which has been prolific for the last few years.
So what this scorecard that is being referenced there specifically does is report the percentage of active mutual funds that underperform their benchmark across different categories and across different horizons, with those horizons ranging anywhere from 1 to 20 years. The scorecard is very transparent with its methods, and so it's straightforward to replicate their results. And whether we use the original scorecard or our replication of the scorecard, the results strongly suggest active funds underperform in the long run. There's a quote from the year-end 2024 scorecard that reads, over the 15-year period ending December 2024, there were no categories in which a majority of active managers outperformed. And if we look at the summary of our replication of the scorecard, we can see that type of result. For example, for US equity funds, we see that over the last 20 years, about 92% of them were underperforming. But the key thing to know here is that while the scorecard's math is technically correct, its analysis does not align well with the experience of actual investors in active funds. In particular, we think there are 3 methodological choices being made in the scorecard that are of paramount importance to address to better align the analysis. And importantly, after improving that alignment, we find that the scorecard dramatically understates the value active management has created for investors. The first choice we think is of particular importance relates to survivorship. The scorecard considers any fund that exits the sample for any reason to be an underperformer, regardless of that fund's actual performance. And while undoubtedly a substantial portion of funds do leave the sample due to poor performance, there are also a significant percentage of funds that exit the sample despite outperforming. And we think that those funds generate value for investors. If you're present in the sample for 19 of the 20 years, and over those 19 years you outperform your benchmark, we think that should be counted as an outperforming fund. And so our fix is to consider a fund's actual performance prior to its exit. If while present you outperform, then we consider you to have outperformed. The second choice that we think is important to address is fund assets. A stylized fact among mutual funds is that most assets are invested in a small number of funds. The top 5% of funds by assets have more assets than the remaining 95% of funds combined. And what that means is when the scorecard weights its analysis by fund, it's skewing away from the actual investor experience. That's because from an economic standpoint, 10 $5 million funds underperforming is significantly less meaningful for investors than one $5 billion fund outperforming. Our fix here is to weight the analysis by fund assets. And to avoid bias in that process, we specifically weight by assets before the horizon begins. The final choice that's important to consider is the benchmark that you're using to evaluate performance. The scorecard compares fund performance against hypothetical benchmark returns. Think the S&P 500 or the Bloomberg aggregate. That's a traditional practice, but investors cannot capture those returns. They can capture the returns on index funds, but only at a cost and only with portfolio deviations. This is particularly important in the fixed income space. Consider a high yield index fund. Those funds come at a significant cost, and the portfolio that fund holds tends to be significantly different from the underlying benchmark. And so our fix here is to compare active fund performance against equivalent index funds, to take the funds in a given category and compare them against index funds in that same category. Now, when we alter those 3 choices, we are effectively reframing the question of analysis. The scorecard asks, what is the percentage of active funds that either leave the sample or underperform the benchmark? In comparison, our analysis asks, what is the percentage of active fund assets that, while present, underperform a portfolio of equivalent index funds? We believe our question better addresses the investor experience and better answers whether investors obtained value from choosing active management. Now, after making those changes, we can see a substantial change from the results reported in the scorecard or from our replication of that scorecard. In particular, if you look at US equity funds over that 20-year horizon, our replication of the scorecard has that underperformance rate at 92% of funds. Whereas after our adjustments, we find that just 55% of assets were underperforming. Put another way, we go from overwhelming evidence of underperformance to underperformance being about a coin flip. These results are even stronger if we focus on fixed income funds. Take the 10-year horizon for fixed income funds. Using the scorecards methods, we find about 71% of funds underperform. Whereas if we switch to our methods, we find that just 37% of assets are underperforming. Phrased differently, we are finding that 63% of assets are outperforming. So in the fixed income space, the result flips entirely, with now outperformance being the most common outcome. And just to emphasize this result for fixed income funds, here are the results across all the categories and all of the horizons. The most notable thing here is the amount of green that you see, with green representing outperformance. But if we look at some particularly important groups, like high yield funds, we can see that over the last 15 years, just 12% of the assets among high yield funds underperformed. Or, phrased in the opposite way, about 88% of assets among high yield funds over the last 15 years outperformed.
So, I began talking about the conventional wisdom and how it's too negative about the value of active management, and I think we feel the same thing about the scorecard, right? We think it's understating the value that was created through active management and experienced by the investors over that time period they were invested. Once you align around the central point of the investor experience, we find that the performance of active funds has often been equivalent to, and in many cases in excess of, the performance of index funds, but fixed income being one of the spaces where the impact is most notable. So when we see 90% being quoted out in the world in the media as one of the downfalls of active management, we just don't feel like that's a reliable understanding, particularly given the context of what we understand in the academic setting.
Thank you both for a great explanation of the study. Please send in your questions, but I'm going to start by asking you, and I'll direct this to Professor Riley. How would you sum up the paper and its importance in 2 or 3 sentences?
The key is that the scorecard is not well aligned with the experience of actual investors. If you improve that alignment, what you end up with is a much more balanced portrayal of the performance of active management.
Let me just delve a little bit more with some questions that we've gotten from a number of commenters who've read either the study or reports of the study. Some commenters have raised issues about your selection of asset weighting versus fund weighting, and can you explain a little bit more about your thinking in that choice?
Yeah, so the number one thing with the equal versus asset is that the equal weight is literally including every fund equally, and Tim makes a point earlier about $5 million funds are small and they may underperform, but if the $5 billion fund outperforms, it's way more meaningful for the investors. So really trying to get at what were investors harmed or helped by active management really became central to the question. And so it's maybe be a little nitpicky on the methods. We look at what were your assets at the beginning of the performance time period and say, well, what did you experience over that time frame? And so that's the thinking, is that captures what those investors at that time experienced if they were to have held the fund over the whole time period.
And I think that's an important point you raise in terms of using the beginning of the time horizon. You're not looking backward, you're looking at the experience from the beginning. you want to talk about that for a little bit?
Correct. Yeah. We try to be very careful not to introduce biases into our analysis we don't want to introduce anything into our approach that would allow us to look into the future. And so when we are thinking about asset weighting, we're considering the assets you have before any of the performance that we're evaluating is going to be experienced.
In terms of the question that you're asking, and you talked about this a little bit, versus what SPIVA and some of the other scorecards are asking, why is the question you're asking more salient to investors than the question the scorecard is asking?
Well, in the end, this is the take-home part, right? So if you invested the money in, this is what gets taken home. I think effectively they're assuming people are putting money into random funds, and they could be any of a large number of funds. But the reality is, we see investors are concentrating in a set of funds, and what's so important here is this is what actually they're experiencing. So this is how their portfolio changes as a result of investing in this set of funds.
I think it's
Yeah, go ahead.
I think it's important as well to focus on as economists, it's very important that when we're comparing things, we compare two viable options. And while it is a very traditional approach to use, say, the S&P 500 as a benchmark, it's important to note that that's not an actual option that investors have. Investors have the option of choosing index funds instead. And so we think to have a fair comparison about what an investor can actually expect, we have to compare two options they can actually choose from, and not a hypothetical option that they may prefer, but is not actually available to them.
Right. Even there's a cost to every fund, right? There's a cost to every fund. We have gotten the question, are you submitting your paper for peer review?
Yes, we are submitting for peer review. The process takes some time. We'll get some feedback, and of course, we always want to improve. We're looking for, anything that may be mistaken or a better approach, and we're happy to take that feedback. So yeah, so it'll be under peer review, and hopefully the process will go quickly, but you never know.
You never know, right? In terms of you talk about the investor experience, which is key to the study here. It's obviously very focused on performance because that's what the SPIVA scorecard is focused on. But what other factors have you studied that you think investors should consider in addition to performance?
Well, that's where I think one of our goals with this study was to try to stay within the same framework that SPIVA was using. But as academics, even going back to our prior paper that John had discussed, there's a very rich literature discussing variables that can help guide investors when picking their funds. Within the scorecard framework, we're sort of assuming that investors are picking at random, but no financial advisor ever recommends just, hey, pick a fund at random and see what happens. And so there's a wealth of variables that have been tested to show predictive power with respect to performance, both in their original sample and out of that sample. John mentioned one of them with active share, which has been shown, both within that original sample from the 2009 paper, but also outside of that sample to have predictive power to help guide the selection investors make. And a lot of these variables we found as well that when we think about them in conjunction with each other, for example, if we're looking at relatively more active funds that have also performed well in the past, that you can get additional predictive power by combining those variables together.
And then, investors have their own preferences that may not entirely be about performance. You could have a Catholic values fund or an ESG fund or whatever strategy where performance is a secondary to maybe the impact of the funding. So that's also in the sample and may or may not look good depending on how you measure your performance.
Can we talk a little bit about timeframes for evaluating performance, time horizons? How did you select those time periods? And also, what do you think about the methodology in terms of the choices of those time periods?
So we were trying to stay within the framework as much as possible to, to make sure that they really understand what's happening and also to, again, to try to drive comparison. One of the pieces, that 92% number being an example, that it comes from the 20-year time frame, and that's pretty atypical, right? I mean, even the most performance measures are 1, 3, 5, and 10. And so looking at 20 years, well, many of the funds will be in the sample for 20 years for a variety of reasons not related to performance, right? And then the other part is most investors aren't holding things over 20 years. That's You talk to any plan administrator, they're evaluating their funds quarterly or annually at least, and trying to understand should this stay in or go out. And the department, the and sector's just more dynamic than that. So 20 years is a little uncomfortable for that. I should say from the academic point of view, performance is often done for 1 month to 1 year, and I think long-term performance measurement is less well understood, and so I think that's an interesting and fruitful area to explore. 20-year performance is makes me a little uncomfortable to draw any kind of strong conclusions.
I was actually having a meeting with a graduate student earlier today, and it was about this exact topic, John, about thinking about long run performance prediction like this. So it definitely is an area that, as academics, we are working to understand better.
Yeah, it's an interesting set of different variables. Um, to that end, could you talk a little bit about, there were some things that you studied that turned out to be not significantly significant. Um, can you mention a few of those and what your conclusions were?
Sure, absolutely. There were a few things where we thought, well, there's a better approach than what's done in the scorecard. And we still think it's a better approach, but it's not actually impactful on the results. One example would be that in the study, the study effectively assumes that the beta for every fund is equivalent to its benchmark, which is um, not true on an empirical basis. But we find that if we try to estimate those betas and integrate them into the analysis, that it doesn't actually change any of the conclusions in a significant way. Another test we ran was that there's no actual statistical tests in the paper to say, is this actually statistically different from, say, 50%? But what we found is if you add those tests in, it doesn't really change your conclusions very much. We found that except in cases where the estimated value was almost exactly 50%, that all these results were statistically significant. And so there are several areas where, in theory, you could further improve the scorecard, but those weren't areas that changed the results in either direction in any significant way.
In terms of the results of, okay, well, active, for example, outperforms with respect to fixed income. We've gotten the question of, including from the press, what about fees? Did you account for fees in this? Yes, maybe they outperform, but what impact did fees have on that? You accounted for that in your study.
Yeah, and that is important, right? We it would be very misleading to ignore the expense ratios associated with either the active fund side or the passive side of the equation. So yeah, everything we were discussing here is net of fees, and when we compare to the passive options, that's also net of fees. Particularly like Tim alluded to in the fixed income space, right? So people think of passive being a lower cost, and even on the fixed income side, they are lower, but many of particularly the high yield or the more shallow parts of the market, the expense ratios are quite high.
Right. It's important to take all of those factors into account in the study, and in fact, you did.
Yeah.
I don't think we have any other audience questions. Folks, feel free to send us a question as we're wrapping up here. In terms of how folks should now, going forward, look at the scorecards, and particularly the SPIVA scorecard, but I think there are elements of this in other scorecards that have been published. What should readers of these scorecards or press about the scorecards think about going forward?
I think the key in that area is our paper cannot tell anyone which investments they should be picking. That's based on a lot of personal circumstances, what your goals are, what your resources are. But our goal is to provide a much more balanced narrative. Like when you do have to make those decisions, you want to make those decisions with the best possible information you can have. And we feel like the scorecard is not going to provide the best inputs to that decision-making process, that the guidance it's providing is less accurate to what you can expect as an investor going forward compared to the results that we're providing.
Terrific. In terms of what I would commend our participants here to do, read the full paper. We have only covered some of the categories here. For example, there's a lot more detail on the different types of domestic equities, international. So there are 11, I think, plus very detailed charts I would commend to your attention. This is a great resource for folks. And I'd be happy to answer anyone's questions after this. If you have any follow-up or ideas for future research, please give us a call, ask any questions. We are always working to balance the narrative and make sure that there's accurate information in the marketplace. So with that, John and Tim, really appreciate your participation, your great work on the study, and look forward to the next conversation.
Thank you,
Thank you
Karen.
very much, Karen. Thank you for having us.
Thanks everyone today. Take care.
Have a great day.